So yeah, let's talk about some of the specifics of the QASH blockchain. So one of the things is that we want to have a seamless currency conversion. So we want to have the blockchain completely plugged into the Liquid platform. And we think that in and of itself is an immensely useful feature for any financially focused blockchain service. So imagine if you're a credit card provider or a wallet or something like this, that's very useful. But also if say you're doing some sort of insurance service and you want to offer these things globally, and you don't want to have to worry about all the conversion processes. You want to allow people to pay in multiple currencies like Dash, things like that. So that's one very important point. Another one is it's a very pro KYC, and one of the things that we're looking at is either opt-in KYC, where we maintain on the back end an anonymous KYC. So in other words, we maintain that the user has gone through KYC, but that that information is not publicly available. But if the user chooses to, they can, in their transaction, reveal that KYC information. And what that does is it allows users on the other end, the service providers, to know that, okay, here is a KYC checked user. They've already passed all the checks. All the information is already in there. And the opt-in side of it is because, of course, you don't want all your information out there in the blockchain for anyone to see. But should you choose, you can allow a service provider to view that, right? So that's another very important one. Another thing is all of the work around what we call the distributed counterparty risk and the margining and settlement. So this is quite an involved discussion, but I'm going to just sum it up. I'll try and sum it up as quickly as I can. Let me start with a little bit about background. In the FX markets, there's something called continuous link settlement. And what continuous link settlement is, it's a way for large banks to settle their credits and debits against each other. But there's a really important point here. Well, there's two really important points. One is that it's continuous. And actually, we'll get into that in a moment. But let me explain just a little bit about how it works and how it ended up saving the banks a huge amount of money when Lehman Brothers went bankrupt. So around 2008, when Lehman Brothers, or 2007, I think is when they actually announced it, 2008, when they went bankrupt, they obviously were not able to meet their obligations. And normally, this would have caused huge problems for the people who are holding the other side of that. But because of the way continuous link settlement works, there are also a whole bunch of people who had credits that normally would have gone to Lehman's. So instead of those credits being paid out to Lehman, those credits were paid out to all of the people who were expecting to be paid from Lehman's. And what that did was, essentially, it shifted the risk from, a huge counterparty loss to just the FX risk on that. And so what's so fascinating about this is, here was this massive event that shook the financial world, and yet when it came to the whole FX settlement, the continuous link settlement was able to mitigate almost all of the losses through this system. And there's a question of, so how did they do this, right? So the way it works is, when you pay into the continuous link settlement, you don't get paid out immediately what you're due. So let's say that you pay in 50% of what you're due. Well, at that point, you don't get back 50% of what you're expecting. You get back less than that. So there's always this kind of buffer in there. And you don't actually get your full credit unless you fully paid in. So if you pay 100% in, at any moment you get 100% out. And what this does is this creates this buffer. And it was that buffer that really saved a lot of these banks. So now, how does that relate to our own blockchain, right? Well, one of the key things that we're doing is we're creating this alliance with other exchanges. And Bitfinex has already chosen to join us in this. And what we want to see going forward is a cash CLS, a cash-based CLS. So what does that mean? It means that exchanges throughout the world will choose to opt into this, and will be paying into the cash blockchain in the same way that you pay into CLS. But we won't get immediately paid out unless we pay fully in. And what that does is it creates kind of a buffer between the various liquidity providers, and ensures that if anybody cannot meet their obligations, then there's something to draw on, right? So that's why we're calling it kind of a distributed counterparty risk. Yeah, the guy to really explain this is Seth, but I've kind of butchered it a little bit, but I think that's the essence of it. But now we look at, well, okay, so you do this on the blockchain, and there's an immense value there because it's it's open, and it's transparent, it's trustless. But then there's some other things that you can add in there that are really interesting. One of them is a kind of an opt-in socialized loss mechanism. So, I admire BitMEX. They do a great job of this. They're one example of this. So what you do is, off of every transaction, you take just a very small amount, and you put that into a cache. And what that does is it over time, it builds up this big pool. And what we want to do is to allow new financial businesses to opt into that. And kind of like you would opt into deposit insurance, once they build up a portion of that, once they begin to contribute to that, should anything happen, they'll be able to draw on that, right? So that's the idea of something which we call the opt-in socialized loss mechanism, right? So, and there are a lot of other things. I'm looking at the document that Mario is preparing here. There's a tremendous amount in there. I think that we really need to produce a blog post to explain it fully in detail. But probably the other most really exciting thing about this is what we hope will allow for, let me just read actually what he has here, for a much more low latency blockchain experience. So transactions, instead of taking 1 hour, will take hopefully seconds, maybe at top minutes, right?